Suddenly, Kohl's stock explodes more than 40% in a single day on 50 times normal volume. Is this another meme stock fever dream, or the start of something big? Let's break it down. The surge was triggered by earnings that obliterated forecasts. Wall Street expected a 19-cent loss for Q3. Kohl's delivered a 10-cent profit, a 29-cent beat. Revenue landed at $3.58 billion, while comps fell only 1.7% versus the feared 2.5%. Gross margin also expanded. Bottom line, for the first time in years, Kohl's delivered a profitable third quarter. Pure rocket fuel. For years, Kohl's was a boxing ring of activist brawls and failed buyouts. Then new chair Michael Bender slammed a focused playbook on the table. The plan: chase margin, not noise. Jewelry sales are up double digits. Private brands now make up 1/3 of sales with much higher margins. They're cutting costs with SG&A dollars declining, and digital is growing mid-single digits. These aren't just buzzwords, the green shoots are showing up in the P&L. And then the kicker: guidance moves up. Full-year EPS now guided to $1.25-1.45, midpoint up 50 cents. On screen, $1.35. Sales decline, narrowed to down 1%, down 2%. Arrows point higher even as comps stabilize. Gross margin, guided plus 100 basis points. That's mix and discipline flowing to profit. Translation: 2025 earnings poised to top any year since 2019. The street notices, Telsey bumps the view. TD Cowen nudges ratings and targets, notes pile in. Tone shifts from cautious to constructive. Calendar flips forward. The playbook's working. Guidance just said it out loud. At $22.50, this is about 8 times next year's EPS. Peers trade 12 to 14 times. That's a wide gap. A 5% dividend. Free cash flow trends up. That's a magnet for value funds. Year to date, the stock is up roughly 60%, outpacing the retail ETF and outpacing the market. Market cap sits near $2.5 billion. For context, smaller than one well-sized Ulta. Cheap multiple. Real cash. Momentum in the tape. The re-rate case writes itself. Voiceover. Quick pause. Reality check. Apparel is still soft. Foot traffic isn't roaring. Think steady, not surging. 2026 tariff risk could pinch gross margin. That headline can move sentiment. Department stores are in secular decline. Fewer partners, tighter aisles, slower turns. Add it up. Macro isn't a tailwind, and the channel isn't getting easier. The counterweight? Execution. They don't need a heroic consumer. 3 straight quarters. Guide ship margin repeat. Checklist on screen. Execute. Checked. Here's what to watch next. Late January, holiday comp print, flat to low single-digit positive keeps the momentum alive. Street average target sits at $27 bull case, $32 roughly 20 to 40% upside plus the dividend. Deliver 2 to 3 more quarters like this. Clean inventories, steady gross margin, tight SG&A, and this turns into a multi-year re-rating story. So yes, the 40% move looks crazy on a chart, until you see the numbers underneath. Sometimes the market isn't manic, it's catching up. Kohl's might be that rare case.